Good morning and happy Sunday. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is July 28th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about the latest current financial market conditions. Specifically, when to be on offense and looking for opportunity, and also when to be playing defense and protecting your capital. Asbury Research has been providing both investment research and money management to individual and professional investors since 2005. To get more information about us, visit asburyresearch.com and click the Contact tab, which is right here, or you could just click the link in the description of the video below. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with just a couple of quick announcements. Number one, we are offering a 10% off of research subscriptions through July the 31st, which is this upcoming Wednesday. We did a lot of media this past month, IBD. We did an educational webinar for Fidelity Investments, stockcharts.com. And generally, when we do that, we try to put out some kind of a sale so we can get folks that may have been tracking us for a while and following us to to become actual subscribers to our research. So if that's something you've been doing, if you've been kind of watching us and kicking the tires for a little bit, this is a great time, only through the end of the month. Number two, if you are already an Asbury Research subscriber, we will be presenting our next monthly teach-in via Zoom this upcoming Saturday, August the 3rd. If you haven't done so already, contact us to request the link and the password for that. Finally, my most recent video for Stock Charts TV entitled Market Correction Necessary Now to Avoid a Correction was produced on July the 24th, just 4 days ago, and it's available on either stockcharts.com or you can go to the media tab here at asburyresearch.com and you can get the video there. Now let's follow the money by identifying our key areas of focus as we look towards the fall and the upcoming presidential election. The Asbury 6 moves to a negative status. The Asbury 6 is updated daily in our research center, which is right here. We're going to go to that now. It's a combination of 6 diverse market metrics that we have combined, put together as kind of a team, and then we back tested them to look beyond the day-to-day noise of the stock market to determine its actual health. In much the same way that a doctor initially checks the patient's vital signs during an office visit to find out more about them than just how they looked when they were walking in the door. We view the ACE6 as kind of a lie detector test for the market. It helps us and it helps our subscribers to identify real sustainable market advances or declines for these computer-driven traps for investors. We've all seen them. They seem to happen more and more often where the market's up 50, 60 points in the morning and by early afternoon it's down 50 or 60 points. It's very easy for us to make mistakes and be shaken out of good ideas because of all the volatility. So let's look at the Asbury 6 now and let's see where it's at. So right now you can see it's equally balanced between the 6 constituents. 3 are green or positive or bullish, however you want to phrase it, and 3 are red, which are negative. The way that there's several ways to use the Asbury 6. The way that we're going to talk about today, I'm going to do some explaining here in a minute so you understand more about this indicator and kind of manage your expectations as to what this does and what it's for. But 4 or more of one color indicates a directional signal. So we went to negative as of July the 24th because on that day there was 4 or more red constituents. Right now we're 3 and 3. It shows that the market's in balance, kind of reading into that a little bit. The market really needs to hold in here next week if we're going to turn back positive. If we do not, if we can't hold, and we actually tested really important underlying support at the end of last week. Those of you that are subscribers can go over to the Research Center or see our weekly wrap-up report that's going to go out early this afternoon. You can take a look at that chart and see where that support level is in the S&P 500. But anyway, the market's at kind of a tipping point leaning downward because, again, we had four or more negative constituents on the 24th. It would take four or more green constituents to turn the Asbury Research status back to bullish or positive. The next thing we're going to do is talk about how the model works. So let's go here. First of all, um, understand that if we're back testing a model or any any model that's been back tested, it doesn't tell you what the future is going to be. Nobody knows what the future is. You could turn on financial television anytime during the day, and there's six guys in a suit that are going to make forecasts on what they think. We base our expectations for the future or our willingness to take a bet in the marketplace on data, purely data, not who's going to win the election or when's the next Fed hike or was Powell smiling at the latest TV interview that he did, but just pure data. So here is SPY. This is SPY for the year to date since January the 2nd. And here is SPY going all the way back to basically Q4 of 2017. So here's the Asbury 6, and we call it Asbury 6, the raw interpretation of it, which I told you, the fours, four green or four red. That's here in blue. So this year, so far, we are trailing SPY by about 6%, something like that. 6.82 here through Friday for 13.2 for SPY. But note that we're doing it with a lower drawdown of only 4.2% versus 5.5 for the S&P. We've got a better standard deviation here. We have 7.10 here, a little bit lower than the 970, and our beta is only 0.51 versus 1. We don't base these indicators on what's happening over the last month or the last quarter. We base them on what they've done over a significant period of time. For us, that's 5 to 7 years. So here is the A64 raw, let's call that. And this goes back to, again, to 9/29 of 2017. Look at these numbers now. We've got annualized total return of 12.82 versus 11.87 for the S&P. A touch better. Nothing to write home to mom about, but a touch better. But here's where we see the purpose of the model. The maximum drawdown for that whole period for the A6 was 12.82%, or 13.6% right here, the third one down. I'm underlining it with my mouse, versus 33.9% for the S&P. That's 60% less of a drawdown. Here we've got standard deviation only 10.5% versus 17.3. Again, standard deviation 60% less. And then we go here to beta. Beta is only 0.46 here for the A6 versus a beta of 1, which is the benchmark for the S&P. So the bottom line is what this is doing over time is it's giving us the S&P 500 with more than with less than half the risk. So that's the purpose of this, to tell us when the market's internally strong and we could be in the market, or when the market's turning internally weak and we may either want to reduce our exposure to the markets or maybe move to another area of the markets. But that's the purpose of this, to tell us the real day-to-day condition of the market. And again, over time, it has given us the S&P 500 with less than half the risk. The next thing we're going to do here is we're going to go back to the research center. And the next thing we're going to look at is our SEAF model. Our SEAF model currently is right here. Our SEAF model was built, the first version of this probably 10 years ago, because sector rotation started to speed up and we needed a more agile model that would give us the signals quicker. This model measures the acceleration of assets into and out of the 11 sector spiders right here. Together, they are the S&P 500, and we do it in 3 different time frames: trading, tactical, and strategic. So Uh, it's an alpha generating model, unlike the Asbury 6, which is trying to keep you in the market, letting you participate in the market with substantially less market risk. This is an alpha generator. It's outperformed the S&P over the past 4 years with about the same risk. Again, all of the caveats to back testing and all of the disclaimers that you're going to see here throughout the presentation today. But if you want to learn more about that, all you need to do is go up here to models, scroll down to the SEAF model, and you can see what some of those tables and charts look like. Uh, the financial sector, as you can see, is one of our picks, or one of the models picks. The top three currently are utilities, financials, and healthcare. That's where the money's going right now. The money is coming from the bottom three, which are technology, energy, and also consumer discretionary. Look how weak technology has been for the past couple of weeks. It's been the fastest money out in both the trading category and the tactical category. And it was the same, the version prior to this 1 week earlier, it was also the fastest. So that money came running out of there, which is what has caused the market to tumble here over the past couple of weeks. Let's look at what we call a rainbow chart for the financials. So all this is the daily ranking score according to the SEAF model for financials XLF going back a whole year. This is one whole year's data. You can see what we call a rainbow chart. Green is favored, yellow is neutral, and red is avoid according to the SEAF model. You can see on July the 3rd, that ranking moved up to favored. It kind of backed up just a little bit, fell into neutral territory for 1 day, and then it went right back to a favored status. During that period, XLF down here has outperformed SPY, the S&P 500, by 7%. Why? Because that's where the money is going. This is how we use the SEAF model to tell us where the money is going in the sector space and where the money's coming from. Also, since 715, the utilities sector has been one of the selections for the SEAF model. It's risen by 2.4%, while outperforming the S&P 500 by 5.6%. The next thing that we're going to look at is we're going to go to our ETF trade ideas. And we're not going to actually go in there, but we're going to show you where it's at. ETF trade ideas here. We have a couple of ideas that we wanted to show you. The first one that is open here, if we were to click this and go into these trade ideas, we'd be able to see it. But just for saving time's sake, let's take a look at that chart. So we've got XTL is one of those ideas that are on the ETF trade ideas table. We first went long, or we first put this out, I should probably correctly say, as a trade idea right here on 6/3, on June the 3rd. You can see right here is where we went. This is the white arrow. That's where we went long or overweight. And since then, telecom XTL has risen by 9% up here. And it's outperformed the S&P by 6%. So we're always trying to get outperformance as well as outright performance. And the interesting thing about this chart is our model, which are based on trend, relative performance, and asset flows. It told us to buy here when we were underneath the resistance. Now we're through this big overhead resistance level here based on these highs that we made in December and January. We had a nice breakout here, came back and retested this as an underlying support area, and now we're making fresh highs. So this is what we're trying to do. We're trying to get in front of these moves before they start to run away. So heading into next week, this is one of our open ideas. We're also overweight the insurance ETF, which is KIE, since 7/16, July the 16th, and biotech since 7/23, July the 23rd. We're not going to have time to look at those charts today, but those are two more of the ideas that are in that section of the website. So let's go back here and talk about the economic calendar for next week, which is really packed. Earnings all week. We have Microsoft on July the 30th, Amazon and Apple on August the 1st. July 31st is going to be the FOM interest rate decision. And then on August the 2nd, we got the July jobs report. So just a ton of potential stimuli coming out next week to make these charts jump. But that's how we're seeing things right now. That wraps up Asbury Research's Following the Money podcast for this week. Our next Following the Money podcast is tentatively scheduled the 11th. It's going to be August the 11th, exactly 2 weeks from today. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40 plus years of experience in the business and our own data-driven quantitative models. You can request more information about us by going to asburyresearch.com and clicking the contact tab here. Hope to see you here again soon. Good luck next week. It looks like it might be bumpy. And please don't forget to like and subscribe. See you in 2 weeks.